So I think we can forget about a soft landing. Everyone's talking about rate cuts happening in 2024, but even if it happens, the damage has already been done. Now, what we're talking about is, of course, the deadly lag effect. The consequences of high interest rates are crushing global demand, and when you flip an economy built on leverage upside down long enough, you destabilize everything. And now the third largest economy in the world is one step away from a deep recession. Japan is in big trouble, and what they might do could plunge America and the rest of the world into an economic recession. In our lead story today, Japan is suffering from its deepest economic collapse since the 2020 lockdowns. Their GDP has cratered by an epic 2.9% in Q3, and this might prompt the Bank of Japan to do the unthinkable. Remember, this is under a backdrop of endless QE. Japan has been suppressing rates for over 15 years. According to all the textbooks, this is supposed to stimulate the economy. The Japanese economy should be booming, but the reverse is actually happening. Japan's economic contraction is now confirmed to be deeper than expected. From a fall of 2.1% to an absolute crash of nearly 3%, Japan's economy is contracting. This signals a collapse in global consumption and domestic demand as well. People in Japan aren't spending as much as before, and the world isn't importing as much products from Tokyo as before as well. Household spending has fallen by 2.5% in October. Nominal wages have grown by 1.5%, but that is half of their inflation rate. So local Japanese people, they are feeling poorer and poorer, and this is reflected in their spending habits. Firstly, the culture in Japan is not like the West. When inflation rises, they are more prone to saving money instead of spending. I know that's very counterintuitive, but that's how many Asian economies really behave. But the bigger issue here is how this is signaling global demand in the world is starting to collapse. Japan's economy is a barometer for the global economy. Remember that the yen has crashed by 20% since the start of the Fed rate hikes. So foreigners buying from Japan get to stretch their money further. But what do we have? Japan's exports are collapsing like a rock. Exports have dropped by 12.5% in October. This swung Japan, a major exporter, back into a trade deficit of 660 billion yen. Things are going to get even worse in November. The PMI numbers are out, and Japan's manufacturing activity has contracted again in November, falling to 48.1. New orders are cratering because global demand is either going local or dropping off directly. PMI is a leading indicator. Just like Germany, Japan is a manufacturing country. The longer this stays below 50, a recession is inevitable. Kishida, he can inject all the stimulus he wants, but it won't work. It will only make inflation even worse. Understand the blowback effects here. When exports from Japan drop, that means local companies are doing badly. This affects wages back home in Tokyo. Salary growth will never be able to catch up with even the official inflation rate. They'll be holding on to their savings and people won't be spending. Inflation hit Japanese, holds on to cars, appliances longer than ever, which kind of makes sense. Time between purchases of durable goods reaches record high. If you feel poorer, you aren't going to buy a new car. You're not going to buy a new washing machine or computer. You'll delay your next purchase by months or even years. So if they can't afford things locally, we can kiss goodbye to Japan importing stuff from the rest of the world as well. They will have to pay higher prices because the yen is just so weak. Now, this chart shows us that the third largest economy has surrendered to inflation. Imports have collapsed month after month since April this year. Demand from a major economy is now gone. This is a result of the deadly lag effect of higher interest rates. Higher interest rates don't just crush demand back in America, they also destroy other economies. In Japan's case, it caused a currency devaluation of the yen, and this in turn makes it harder for Japan to import more stuff from other economies, including the United States. And here's the situation. The EU and Japan, they're about to enter a recession. China's consumption patterns aren't doing so well either. China is the world's second largest economy. They are the biggest trading partner to half of the world. They export a lot of stuff, but they also import a boatload of goods as well. And this is where the global demand story really gets grim. From Bloomberg, China's weak trade data signals more economic pain to come. Beijing's imports from the world have declined by 0.6% in dollar terms in November. They are also a victim of the lag effect. Global interest rates have been too high for too long. Since the start of last year, China's import and export growth have been falling in tandem. They are selling less to the world, and they are also buying less from the global economy as well. Now, if this doesn't tell you consumers are in trouble, I don't know what will. China's consumption won't save the world. Their export growth is also near 0%. So we also have to take Chinese demand away. We are seeing a systemic collapse because money is really getting expensive. The real economy is suffering and it's being reflected directly in the data. It's just in the charts, guys. Beijing is also a victim of the lag effect, and America won't be any different here. This is where Japan's next move could trigger a collapse of the global economy. They are caught between endless bond buying or allowing interest rates to rise. Either outcome is bad. Japan will likely fall into recession, but will they go quietly into the night or take the whole world down with them? We have to watch this carefully because it's either boiling the frog alive slowly or we get thrown into the deep end all at once. Now, the first option is Japan stubbornly sticking to zero interest rates. They'll continue to suppress rates because now they have the ultimate excuse. There's no better reason to scrap raising interest rates than the economy on the verge of a recession. If the BOJ sticks to endless bond buying now, the yen will continue to crater. This will crush Japanese demand both at home and abroad. You're basically hiding in a wooden house amidst a forest fire. That's most likely what the BOJ will do. The longer US interest rates stay high and Japan suppresses theirs, the longer the dollar will gain versus the yen. It's an almost perfect correlation here. In other words, the Japanese consumers will slowly lose buying power month after month. Now, the other option will take down the Japanese economy and possibly the entire world as well. Just look at how long the BOJ has been suppressing rates. Japan has been at 0% on negative rates since the '08 collapse. This puts the entire economy into artificial life support. They were trying to paper over their fundamental problems with Keynesian economics, but look at the 10-year JGB yields. Even with all the unlimited bond buying, the market is pushing up yields because they know the economy is a house of cards. Investors want a higher return. If the Bank of Japan decides to reverse the gears and hike interest rates to save the yen, this could trigger a financial apocalypse, and I'm not being dramatic here. Yes, the Japanese yen will go higher, but it will be terrible news for global borrowing costs, especially for US treasuries. If Japan raises rates, this will lure money into Japanese bonds because the appreciation in yen will far outweigh any yield US bonds can actually give. If the yen bounces by 10%, that is more than what the US Treasury can yield, which is only around 4 to 5% today. It makes no sense to sell yen and buy dollars to invest in US debt. And the market is getting spooked out about this. Bets are surging that the BOJ could actually hike in December. Speculation that rate hikes are coming has gone through the roof. Now, either scenario of continued low rates or rate hikes is bad for the US economy because under the surface, domestic demand in America isn't looking that great either. If global demand is going away, that means the United States has to rely solely on domestic consumption to survive. That's the most logical conclusion here. According to US Bank, domestic American consumption represents 68% of GDP. Over two-thirds of the economy depends on the American consumer. If that collapses, we can kiss goodbye to Joe Biden's soft landing. While Q3 GDP came in at 4.9%, which is suspiciously strong, other indicators are showing that this miracle is just a one-off. The Black Friday miracle we also saw might be just the last bright spot. Americans are finally turning frugal after splurging over summer. Government data and retailers are warning that a consumer pullback is coming, and we must prepare for this. Personal spending, after adjusting for inflation, has only increased by 0.2%. And at the same time, jobless claims are now at a 2-year high, smashing past 1.8 million. This is more evidence that the lag effect is catching up with the United States. In other words, interest rates have been too high for too long. And we know Powell likely won't be hiking rates anymore, but cutting rates might not happen as fast as we think. The Fed is now receiving a lot of conflicting data from the economy. While consumer demand is softening, the labor market still looks incredibly strong. We know the reality on the ground is much different, but the Federal Reserve is getting bombarded with good news after good news. For example, the US labor market has rebounded with payrolls rising nearly 200,000 last month. Unemployment has also fallen from 3.9% down to 3.7%. Let's also throw in a 0.4% increase in hourly earnings, making it the biggest gain this year. All of these metrics have exceeded the estimates. So if you're Jerome Powell, you have very little reason to cut rates. It looks like the US economy is on the upswing, even at 5% Fed funds. But this is a fallacy. The longer he keeps interest rates high, the lag effect will inevitably hit the economy. In addition, we have several more headwinds coming that will keep borrowing costs higher for longer in the United States. Now, one big one is continued war spending. America will likely borrow another $100 billion from investors to give to Ukraine and to give to Israel. Zelensky is now making another trip to Washington to pressure Biden for money. And it's just a matter of time before he caves in and gives Ukraine their money. Their shared hatred of Russia virtually guarantees it. And this means more bonds will be issued to the market, increasing the supply of US debt once again. Bond yields will stay high. And if you add in more deficit spending, Japan potentially hiking rates, and the Federal Reserve reducing their balance sheet, you get a deadly combination. It's a combo of elevated borrowing costs and liquidity just leaving the system. This is the lag effect that's coming for the US economy. Now, what we fear is a shrinking money supply. It's the restriction of money in the economy that could trigger a recession. According to the Mises Institute, the money supply has fallen by $2.8 trillion or 13% since the peak in April. This is the largest drop since the Great Depression. In other words, money in the real economy is drying up. It's a negative leading indicator that adds further credence, further strength to the case for a recession. In fact, the last time the money supply went negative was back in the 1930s depression. But it doesn't have to go negative to be bad news. Back in '08, it didn't take the money supply to go negative for a recession to happen. It just had to rapidly slow down to cause havoc. By itself, we understand, right? A money supply decline isn't a definitive sign of a recession. There are many other factors out there, but it does add more risk to the argument. It tells us that the lag effect is picking up steam. The longer interest rates stay high, the more deficit spending continues, this liquidity crisis could overwhelm the real economy. Now, is there a chance that a soft landing is possible? Yes, anything is possible. But the facts show that global demand is already weakening in a big way. Big economies are already on the verge of recession. The United States has a longer lifeline thanks to the dollar and endless borrowing. But if Japan blows up in a bad way, the US economy won't be immune. But let me know what you think in the comments below. Will Japan fall into a recession soon? And will America be next? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.